So let's get started. A little bit of an informal disclaimer here. Let me remind you the purpose of this webinar is education. I am not going to be an alert service per se. I'm not going to provide specific trade recommendations or trade calls, but I will take a look back at the trading day that is now behind us to see what Monday looked like on the currency charts, and take a look at what tomorrow may bring. Tomorrow, including the upcoming Asian session starting in a few hours. So let's do that. Well, who amongst you recall, and I'm probably not the only presenter at Epic Street who's talked about this, but at least in my webinars over the past several days, not just last week, maybe the week before and the week before that, can anyone recall any mention that I've made in the past of intervention watch? I'm sure I've made at least one comment, maybe two or three, during these webinars at Epic Street about being on intervention watch, Japanese yen intervention watch. I'm almost certain I've made this comment in this event, in this venue at least once. We've talked about it a number of times at the Epic's Bootcamp, where I'm a currency coach and quantitative analyst, but I'm almost certain I've talked about it here as well. I'm not just referring to, having made a statement that we're an intervention watch, but why? Why was it reasonable to expect that Japan might intervene in the near future? I'm pretty sure when I talked about intervention watch in the past week or two. Okay, so never remembers. Someone remembers. Thank you. Yes, Erwin, those are probably arguably my two themes over the past week or two. And probably in that order as well. Watch Europe and intervention watch. Watch Europe and intervention watch. I mean, folks, if you were keen to those 2 points and watching the right things at the right time and brought your A game when you should have brought your A game when it comes to trading. I mean, the trades on from last Thursday's Asian session, the euro long, and then the intervention trade today, folks. I mean, that could be your trading month. Maybe for some of you, depending on your trading goals, plus depending on your leverage, which I don't recommend too high leverage, but I mean, you could have wrapped up your year almost with, especially with the intervention trade today. Now, as always, the challenge is to get the timing right when it comes to big moves like the one Thursday on the Euro USD in particular, and like the intervention today. But the point I'm trying to emphasize that there were clues as to suggesting that such moves could be forthcoming. I mean, especially on the yen, history was a guide there. History was a great guide there, at least from my perspective. So let's talk about that. I'm going to go to the Japanese yen here. I'm going to show a daily chart for a moment. And on this daily chart, I want to highlight a couple of red arrows with a red box around them near the middle of the chart. What I want to do is I want to explain the reasoning behind the horizontal blue line at 77.70. Can anyone see that the horizontal blue line at 77.70 seemed to define the highs for this pair on August 25th and September 6th? So we had some evidence that area was important in the fairly recent past for the dollar yen. So the 77.70 area was a ceiling for the dollar yen, again a sort of ceiling for the dollar yen in late August, early September. With that in mind, let's go back to a 15-minute chart without indicators. And actually, I mean, the point I want to make is shown right here. Notice how you get the intervention move. Japan intervenes, specifically the Ministry of Finance intervenes. We get broad yen weakness, big time move up on the dollar yen. Dollar yen ultimately rises over the course of not quite 45 minutes. Between 30 and 45 minutes, the dollar yen rises to nearly 79, the psychological level, very close to it. Drops back to that 77.70 level, which again was important in late August, early September. finds support there, continues north, finds a top, establishes a top for the day around 79.5, 79.50. Now the trade on not only this yen cross, but virtually every the other yen cross, the trade you could have gone long, could have consecutively gone long and say, what, you pick your choice, the euro yen, the pound yen, whatever. Pick one of those yen crosses, the Aussie yen. That trade could have been based in large part on expectations that the dollar yen would find support and in the 77.7 area after that area was resistance in late August, early September. Now that wasn't just it. That wasn't the only factor. Let me define the actually let me zoom in on this chart a little bit and turn off the auto scroll. Okay, here's the point I wanted to make. So you got the move up again from today's low around 75.50-ish to the high around pretty close to 79. You can apply a fib study to that move. And I find this is fascinating. The 38.2% fib retracement level of that move up is just below 77.70. Actually has 77.67 based on price action on this platform. A little bit different depending on the platform, but my point is this: a 38.2% fib of that post-intervention move, very close to a level which was important in late August, early September as resistance. What was resistance back then could have viably become support earlier today, and in fact it did after it was broken. So again, whether you were looking long on the dollar yen, long on one of the yen crosses, it could have been based on the dollar yen's test of that 77.70 area. Now, some of you may be wondering, well, why in the world would this pair top out around 79.50? Well, it is a midpoint, so-called midpoint psychological level, price level ending in 50, 79.50. But this justifies a look at the charts, the dollar yen charts with indicators. And I bet at least one of you have already figured this out, why the dollar yen topped out where it did. I'm looking at a daily chart with indicators. On the upper right-hand portion of the daily chart, you can just make out next to my cursor a downward sloping green line. That, folks, is the daily 200 EMA. Daily 200 EMA. And I would argue that's at least part of the reasoning behind the high for the day established right there. Another reason, you can make the case for a low. I forget which low it was now. Was it the early June low? Well, you can almost make the case for the early May low. Early May low, early June low for this pair, not far from 79.50. So you had a roll reversal scenario there as well. What was support in, you pick, early May, early June, became resistance. And by the way, it was certainly not an easy trade. Well, actually none of the trades were that easy just because of the volatility on the yen crosses. But I can almost assure you that there were some hedge funds, maybe more than a few retail traders, who bought the Japanese yen against the dollar, and for that matter against, or even against other currencies, based on the dollar yen, the prospect of the dollar yen finding resistance in the 79.50 area, based on all things I just mentioned, daily 200 EMA, and also the lows established on the dollar yen in early May and early June. So you literally could have traded this both ways today, or at least picked one way. That is, you could have bet on the intervention, gotten it, and then looked to buy the yen back based on the daily 200 EMA plus roll reversal. Well, and also when you consider the magnitude of a move, which has been common on the dollar yen in response to intervention, I mean that's definitely one of the biggest moves you'll see in terms of a classic unilateral intervention. The move in August Started about 77, got to 80. There's a 300 pip move on the dollar yen in early August in response to intervention on that day. And as I recall, the intervention, I can look back on this chart and confirm it. The intervention in September of last year, and you can just see in the middle of this chart now, that intervention was about the same magnitude. As I recall, 300 pips. We're going to verify it. Low at around 83, higher near 86, so another 300 pip move. So by those standards, 300 pip move on the dollar yen after the intervention in September of last year, and again the intervention in August was about 300 pips as well. So when you get a nearly 400 pip unilateral intervention move, that's arguably about as far as it could be expected to go. Keith, first of all, it's the Ministry of Finance, not the Bank of Japan. It's a common misnomer here. The Ministry of Finance that makes the call on interventions. And no, I don't. Well, could they have been looking at it? Yes. Could they have? Would they have done some policy move based on that? I rather doubt it. Well, Keith, what are you implying with the comment that the Bank of Japan, assuming the Bank of Japan was actually doing the actual intervening, I don't know what you're getting at. You think would they have bought the yen back? No, my interpretation, Keith, my interpretation of price action today, Japan intervened in the early Asian session trading today, and the market stepped in to buy the yen. At least buy the yen against the dollar around 79.5, and maybe a combination of that plus those who were in the intervention trade took profit around that same area. And one very common scenario when Japan intervenes is dollar strength against other currencies, not nearly the same magnitude as the dollars move against the Japanese yen, but we do commonly see dollar strength in response to an intervention by Japan, and that's what we saw today as well. And you can see I'm showing the price action on the Euro USD. Starting in early Asian session trading, you see the Euro tracking down. There was a case for selling the Euro on little rallies during the course of that Asian session today. Because again, dollar strength is very common against other major against the European currencies, for example, when after an intervention. I won't say that's the only reason why the dollar is rallying. So Coco brought this up earlier. In fact, I want to make a point here. I want to go back to my other charts, my scan view of multiple currency pairs. Has anyone noticed what the euro has managed to do with the combination of Friday's price action and now today's price action? Let's go to a daily chart here. Remember that big move last Thursday, starting with last Thursday's Asian session? The euro has essentially given up its gains from last Thursday. Yeah, Michael, I'm glad you noticed that. I had a long-time trader and actually one of our coaches. We had a debate about that on Friday. He chose to tell me that trend lines are subjective. You know, that's a good point. I want to show you that. Hang on. I want to show you folks what Michael's talking about here. And by the way, that could have been at least part of the story behind today's or the fall in the euro, both Friday and today. So I'm looking at a weekly chart for the euro, and the trend line Michael's talking about is based on the early June low of last year. So last year's early June low, and plus drawing a trend line connecting that with this year's January low. And it's not perfect, but certainly not perfect. But that trend line arguably did hold. John T., you're talking about Noda. Noda's no longer in that role of Ministry of Finance. Noda is the Prime Minister. Noda is the Prime Minister. So it's no longer Noda at the helm of the Ministry of Finance. In fact, I'm trying to remember his name again. I keep forgetting his name. He's featured in an article in last Friday's Financial Times, which Azumi. I can remember that. Azumi is the new finance minister. It was his call. And Johnny, you make a good point about the implications of the 200 EMA for technical traders and such as hedge funds. I'm not in control. What can I say? I'm not in control of what Japan's Ministry of Finance does. There was somebody talking today on was it either a comment posted by Trade in the News or maybe it was an interview on CNBC. I mean, look at the differences between what Japan's Ministry of Finance has done or maybe not done versus what Switzerland has done. Switzerland's pretty much said we will do everything we can do. Switzerland is prepared to spend unlimited amounts to weaken the Swiss franc. And by comparison, Japan has not made the same kind of commitment. Japan hasn't essentially said in gambling terms, all in. Japan has not said all in. Well, and that's not the only factor, by the way, driving the recent yen strength. You still have Japan running a trade surplus, and there's other factors I'm not going to have time to get into during this particular session. But there are some, in spite of, I still see the number of traders at boot camp and even a coach or two who keep talking up a carry trade on the Japanese yen, and like guys, it may be a little premature for that. So yeah, if you're asking questions about technicals, about moving averages on the dollar yen charts, is the Bank of Japan or Ministry of Finance, whoever it may be, paying attention to this stuff? I don't know. Should they be? Maybe. I mean, one thing's for sure. When it comes to Japan, is it just me or they seem to move very incrementally? I mean, that was one of the reasons why they've had some troubles in the latter part of the 1990s and of course earlier in the previous decade, because when it came to policy moves, they just didn't act boldly enough, quickly enough. And in fact, Japanese officials told U.S. officials just that following the Lehman Brothers bankruptcy in the U.S. Some 3 years ago. That Japan essentially said one of the biggest mistakes Japan made was not acting boldly enough and quickly enough. That's just not in Japan's culture, and it seems like we're seeing that even now to some extent when it comes to interventions. The so-called half-life of interventions is getting shorter and shorter. Well, it doesn't help, but when it comes to interventions, the most effective ones are the ones when you have fundamentals on your side. And in the case of what's arguably been contributing, at least in part, to the Japanese yen strength, concerns about Europe, and really even broader concerns about the global economy, it's safe to say those concerns have not been adequately addressed. Those concerns have not been adequately addressed, at least in my mind. This may be a good segue for. Well, actually, let me talk about one thing first before I move on to the Euro USD or the dollar and what maybe even tomorrow's trading sessions here. So I want to talk about clues. Clues to this intervention. What were the clues which could have kept you on guard for an intervention by Japan? Well, recent comments by Azumi, Japan's finance minister, were one big clue. Folks, anytime you hear a Japanese official like one at the Ministry of Finance make references to decisive action, to bold action, those are key. Those are important key words when it comes to Japanese officials. When Japanese officials make reference to bold moves, decisive actions, those are pretty reliable key precursors to Japanese officials actually doing something. Talked about this in Ethics Bootcamp about a year ago. This was in late August. We were talking about the history of Japanese officials and when they tend to do something or not do something. And one analyst back in summer, about more than a year ago, during the summer, had done some research on this and had discovered that Japanese officials tend to use terms like decisive when it comes to actually doing something meaningful, doing something fairly bold. And there were references back in the first week or so of September of last year, references by Noda. Noda at the time, it was the Japanese finance minister. Noda made references to bold acts, I think it was this decisive action, whatever the equivalent Japanese term was. Noda made references back in early September of last year to decisive action in the currency markets. Days later, Japan intervenes. So a unilateral intervention. As I recall, back in March of this year, that we had the broad yen strength in response to the tsunami and earthquake in Japan. The yen strength was you could chalk it up to a combination of sort of a risk-off mood. Markets concerned about the implications of the Japanese earthquake and tsunami. Plus, there was sort of a repatriation trade there as well. Many thought that there was going to be massive amounts of money flow from Japanese investors back in Japan to help pay for repairs and such while following the earthquake. So the yen gained massive strength during a 1 week period back in March. In fact, I can show that on this chart, I guess. It's a weekly chart, and that big spike down, that long wick on that weekly candle, that was intervention week. We actually had a big yen rally in the early part of the week, and then Japan. And that was a coordinated intervention involving multiple central banks, not just Japan. But my point is this: before that intervention in mid-March, there was the day before the actual coordinated intervention involving multiple central banks. Reference made by a Japanese official, it might have been noted, I'm not sure. A reference made to doing battle with the currency market. Now, it wasn't the classic keyword of decisive action or bold action, but you know what? That's doing battle with the currency market. That's strong enough language. So again, Japanese officials. Here's the lesson here. It's something you can look to apply later. Japanese officials tend to use more, and I'll say the same term again, decisive words. They tend to use bolder words, more aggressive words when in reference to prospective policy actions. That's just what they do. And the other factor here, and I referenced this on my Twitter page, there was an article, and I'm looking at it now, an article in Friday's Financial Times, article titled "Hot Yen Leaves Tokyo with Cold Hard Choices." And one of the things referenced in the article was there's an analyst at Nomura talked about the correlation between Bank of Japan policy moves and foreign exchange intervention policy. Now, so what does that mean? Well, the Bank of Japan tends to adopt or pursue further easing policy, often days before in an intervention. You might say that you can almost suggest that the Bank of Japan does that to sort of pave the way for the intervention to be at least maybe a little more effective than it otherwise would be if the Bank of Japan did nothing before the intervention. And the move, some of you may recall this last week, the Bank of Japan actually expanded its asset purchase program by, was it 5 trillion yen or something like that? I may be off a bit, but I believe they expanded their asset purchase program. And so, in other words, the Bank of Japan is going to be buying more JGBs, Japanese government bonds. So it's been very common and the article pointed out, the analysts cited in the article pointed out, it's been very common for the Bank of Japan to do some form of easing policy, whether it's lowering rates or buying government bonds or something like that prior to an intervention. Oh, Coco, the point is a weaker currency. Now, it's actually, you might say it's a mixed blessing, but, because on one hand, if you're Japan, especially a country that a country that acquires, a lot of the commodities it uses externally. I mean, Japan is not a commodity-rich country. So it does have to buy a lot of commodities in the open market, and a strong yen helps with that. But at the end of the day, what Japan is a net exporter. Japan is a net exporter, and in other words, it exports more than it imports. And exporters want a cheap currency, want a weak currency. So yeah, the comment made there about everyone wants weak currency. Yeah, and the problem with that is not everyone can have weak currency. There's no you can't expect a win scenario, right? I mean, somebody's going to lose there. Somebody's going to be less pleased, you might say, with movements in the currency markets. So Coco, does that make sense? Well, Coco, let's get to basics here. A weak currency makes a country's products more competitive in the global marketplace. Let's say you're an exporter from Japan. If the dollar yen, okay, where's the dollar yen right now? Let's look at it right now. Go back to my dollar yen chart here. Oh shoot, I'm gonna have to reset the auto scroll on that. Dollar yen about 78. Dollar yen at 78. Japan's cars in the U.S. Japan's cars would be cheaper to U.S. consumers if dollar yen were at, say, 87, 97, 107. The higher the better. Right now, in relative terms, Japanese cars are more expensive because of how strong the Japanese yen is against the dollar. So, Coco, that's why you have, and not just Japan, but there's been other central banks intervening in the currency markets to weaken their currency against, especially the U.S. dollar, given the size and strength of the U.S. economy. Still a source for now of the biggest, consumer population in the world. Strong consumers there, although not as strong lately as what they were back in the prior decade. So, Coco, that's it. It's just the main driver, weaken the currency. To weaken the currency to help exporters in that country. And yeah, you might say it that way. It's what's the priority there? Cheaper commodities versus more benefit the exporters, and the exporters win. At least in Japan's case. And so there's comments about a weak dollar, and that's one of the big battles that Japan has to fight right now. If you look at the dollar yen currency pair, you've got a battle of you might say a battle of two central banks, a battle of two governments in terms of policy. On the one hand, you've got the dollar, and what's driving what's one thing driving the dollar? Well, you have a Federal Reserve, the U.S. Central Bank, which is still pursuing very accommodative policy, very loose so-called policy. The Federal Reserve's gone through QE1, it's gone through QE2, it's now going through a program called Operation Twist. All of those policy moves, and by the way, the Federal Reserve still employing what's called zero interest rate policy, or ZIRP, rates basically at zero. I mean, all of that means or still suggests or still supports the idea of a weaker dollar. And, some think, and I can't disagree with this, some think that one driving reason why the Federal Reserve is leaning towards this so-called loose policy is to keep the dollar weak. Now, why would the U.S. want a weaker dollar, even though, of course, the Treasury Department states it supports a strong dollar policy? Well, some of you may recall, U.S. President Obama stated I believe in his first year as president, a goal of doubling U.S. exports in 5 years. And what would be one way of increasing U.S. exports? A weaker dollar. So that's the battle faced by Japan. It's almost like the Bank of Japan pitted against the Federal Reserve, or more broadly speaking, the Japanese government against the U.S. government in terms of the overall, monetary plus fiscal policy. And right for the time being, U.S. is winning that battle. I wouldn't say imminent. A possibility, yes, and probably more of a possibility next year than this year. You're going to have a changing of the guard when it comes to FOMC voting members. Right now, we have a fairly hawkish bunch that are designated as voting members of the FOMC. Fairly hawkish bunch. There's three notable guys there. The Minneapolis Fed president, whose name I always forget, he's a funky last name, Richard Fisher of the Dallas Fed, and Plosser at the Philly Fed. Three notorious hawks at the Fed. Hawks meaning they're much more concerned about future inflation, and as such, they've been less inclined to vote for these further easing measures like Operation Twist, they even objected to the decision by the FOMC in August to commit to keeping the Fed funds rate low through like mid-2013. Even they didn't even like that. So these are guys that think that what the Fed is doing is eventually going to spark rampant inflation, and they want no part of that. Now, again, the voting members of the FOMC, they rotate from every year. Not all of them, but some of them rotate every year. So the folks that are some of the folks that are voting now will rotate out, and we'll bring in new voting members next year for some of those voting chairs. And so as a result, we may see an FOMC voting cast that's a little more dovish starting next year, and that could pave the way for at least a higher probability of QE3. Now, one hurdle, if you will, for QE3. What can I say? Washington D.C. There's just right now there's no appetite for fiscal stimulus. There's more of an appetite, if anything, for austerity, for cutting spending, for reducing stimulus in Washington D.C. And there's a lot of political banter. I don't know if that's the right word to use, but there's some politicians in Washington D.C. There's some senators and representatives in Capitol Hill that are not thrilled with the Fed having done what it's already done, QE1, QE2, and Operation Twist. And so, the Fed's, although the Fed is officially an independent central bank, it's probably going to be feeling at least some pressure not to pursue too much more in the way of easing policy. So, well, if you look at it from a literal numbers perspective in terms of economic data, you'd think the case for QE3 would be bolstered by some lower measures of inflation. We don't have that yet. We may get there soon, but we don't have that yet. Cocoa, yeah, I don't have the access to those numbers right now, but yeah, there's ways to look that up. And if you're asking about Libya and Gaddafi, I don't have any insight on that. I shouldn't say I don't have any, but I just, those don't look that's not quite as relevant right now. I mean, what can I say? There's a number of different things we're focused on in the currency market. One of the big things we're focused on is Europe. I mean, in a normal market, if there wasn't a real threat of Europe imploding, maybe those issues you're talking about, Libya and Gaddafi and stuff, maybe those would be more important. Until those issues like that prove to be important in the market, I'm probably not going to pay much attention to them. Money magnet, that's a good question. That's possible, yeah. Money magnet, it's kind of like the cockroach rule. You know what I mean by the cockroach rule? What is it? Or not just money magnet, but anyone. What I mean by the cockroach rule? Let's see if someone follows me there. Yeah, when there's one, there's more. Exactly. Probably depends on part on how tough things get for it. Oh yeah, speaking of Europe, I want to make this point before I wrap things up. I've got a little more than 5 minutes left. I do want to carve out some time to cover, take a look ahead and what could affect the markets tomorrow. Been harping on this, watch Europe bandwagon. Well, I'm going to show you in a moment. Actually, I got to adjust this. I'm going to show you in a moment here a website. It's actually Bloomberg on Bloomberg.com. I don't know. This can be confusing. You see the number 1.161%. That's not what I'm focused on. What I really focus on is next to value, 6.09%. That's the yield. That was I believe it's the closing yield. Maybe I haven't updated this lately, but I believe that's the closing yield according to Bloomberg.com. The closing yield on the 10-year Italian government bond. Folks, that is the highest level, the highest closing level we've seen on the 10-year Italian government bond since early August. And what I find interesting is this. Think of what I just discussed here. The euro. The euro has given up all of its gains from last Thursday. That seemingly euphoric move, likely driven largely by short covering, by a short squeeze. That big move, a relatively big move on the euro last Thursday. Those gains are all but gone now. They're gone, and the yields on the 10-year Italian bond still elevated. So it's interesting times. Oh, and one thing I was going to mention with regards to the deal that was put together by European officials. This was late Wednesday night my time, early Thursday for most of the trading public. Let's face it, the deal is, number one, lacking in details. How exactly will the Europeans bump up the EFSF, the rescue fund, to at least 1 trillion capacity? Number two, is that even enough? I would argue, I and many others would argue not, that 1 trillion is not enough for the EFSF, that rescue fund. When it comes to Eurozone bank recapitalization, the number pinned on that is about 106 billion euros. The IMF recently estimated, I believe, was it last week or the week before? And I even losing track of my weeks here, but the IMF, the International Monetary Fund, they're pegging that number close to 300 billion euros needed for proper Eurozone bank recapitalization. And you might recall Christine Lagarde, the IMF director, was talking about a number around like 200 billion euros during her Jackson Hole speech at the Central Bankers Conference in Jackson Hole, Wyoming, in the U.S. back in late August. And she ruffled a lot of feathers in Europe by saying that. But my point is this: that number's not getting any lower. That number for U.S. bank not U.S. bank, but for Eurozone bank recapitalization. So the wrap up the whole European situation, the assessment of what happened in Europe last week. A step in the right direction, yes. A sufficient enough step, arguably not. And even the step that was taken, there's a lot of details missing as to how they're going to get to what they've committed to get to. So that's admittedly a simplistic, but a wrap up of what Europe announced last week, and how significant or not that it is. Look ahead here. I'm going to take a look at the economic calendar provided by FX Street here. There is a a PMI number out of China coming during today's Asian session. That's been known to move the market in the past, but I would ignore that. I would not ignore the PMI number out of China during today's Asian session, especially if it's a surprise number, surprisingly low or surprisingly high. That's been known to affect the market in the past. One I would particularly pay attention to, though, in terms of market-moving news events, Australia's interest rate decision. The Reserve Bank of Australia is the central bank of that country, and their next interest rate decision is due out at 11:30 p.m. My time, 11:30 p.m. New York time. Now, odds are, as shown here on the Epic Street calendar, odds are they're not going to change their main interest rates. But what the market will be looking for is changes in the language of the RBA statement compared to the prior statement. Are they going to be sounding more dovish? Are they going to be sounding more hawkish? Or if they sound more dovish, they're going to express concerns about things like, growth in Australia, maybe concerned about another rise in the unemployment rate. Maybe they're going to reference that inflation's going to drop sooner or drop more quickly, or than what previously was thought. And the opposite case, if maybe they're going to sound a little more hawkish than what they sounded last time. It seems like odds, if anything, have been built, or speculative bets have been building towards a rate cut by the RBA. So I would guess this, if anything. It's just a guess here. I'm going to be looking to the statement myself to see what gives. But my guess is this: the market's probably been increasingly poised more for a forthcoming rate cut than anything else. The bigger reaction on the Australian dollar today could be if the RBA doesn't show any inclination more towards a rate cut. If the RBA stands pat or sounds even a little more hawkish than previously thought, that could give a boost to the Australian dollar and really prompt at least some Australian dollar strength throughout all of tomorrow's trading sessions. Thanks, Ahmad, for posting that the link to that calendar. Appreciate that. So that's one key event on tomorrow's calendar, the RBA rate decision. And again, the key factor there won't be the rate per se. It's likely not to change. Although if it was a change in the rate, that could move the market. The likely key there will be the statement itself. And for the statement, do a Google search on this. Reserve Bank of Australia. If you search, I can do that right now. If you want to find their website, I just do something like this: Reserve Bank Australia. Go first with search results to their homepage. And you will see posts on their homepage soon after 11:30 p.m. New York time. What is that? A little less than 10 hours from now. You'll see soon after that time their latest the statement. So there might be some clues there. And what you could do is compare that statement to prior statements from that central bank. Look for change in language. What else? PMI reports. Tomorrow's the first trading day of the new month, and with that, we almost always get some kind of purchasing manager index reports. There'll be some PMI numbers out of Europe, out of the UK, out of the US, and those can affect the mood of the market. So keep your eye on those. Again, these are purchasing manager indexes. They provide the first look into the health of the manufacturing sector in various economies in the prior month. And the manufacturing sector tends to be important because it's one of the first sectors to turn down in a downturn or turn up in a recovery. Hey, Money Man, I see a question about numbers point to recession. So when you say how will they be able to pay for all the stimulus that is needed, who are you referring to? Are you referring to one of the central banks we've been talking about? And folks, that's about it. The RBA rate decision and the PMI numbers could set the tone. And by the way, as always, I say keep an eye on Europe, specifically the yield on the 10-year Italian government bond. That could affect the tone of the euro? Oh yeah, money magnet. So you make a valid point. That's the question. I'm sure everyone's asking right now. Yeah, it's a valid question. I don't know. You know what? I'll leave you with this thought. I found this interesting. There was they announced, or the EFSF announced. Let me turn off the volume from Trade the News. So the EFSF, that's the rescue fund in Europe, and that's one piece of the overall Eurozone rescue equation. You have again, there's three aspects to what the announcement last week by the EU summit, by the European leaders that met for this summit in Brussels. The three keys. One is the so-called haircut for Greece. How much of a cut on the par value of the Greek sovereign bonds that are held by bondholders. How much of a cut are they going to have to take, or how much of a cut on the value of those bonds they're going to have to take? That's one thing. Second thing is how much will this rescue fund, the EFSF, how much will it be increased? And the third thing is recapitalization of the banks. Well, on that second thing, and remember, some of you may recall, these are kind of sequential. The haircut will dictate to some degree the EFSF rescue fund and the size it needs to be, which will in turn dictate the proper recapitalization of the Eurozone banks. Well, the rescue fund itself, what one major source of funds for it is this EFSF sells bonds. They have bond auctions. They're going to have some bond auctions coming up soon. And I noticed just today, the EFSF was originally planning to have a 5 billion euro bond auction. And I believe just today it announced it was going to lower that to a 3 billion euro bond auction. So, what does that tell you? Are they concerned that they're not going to be able to raise the full 5 billion at the originally scheduled bond auction? Reason to believe the demand's not there. It's something I admittedly haven't read up on, but I saw a note actually just minutes before I started this webinar that the EFSF next bond auction was scaled down from the originally planned 5 billion euro offering to a 3 billion euro offering. Actually, kind of sad when you think about it. Yeah, and Money Magnet, you make a valid point about the haircut and how that doesn't trigger the credit default swaps. All good questions. Which let's put it this way: this issue is not resolved. Europe's not fixed. Although right now the focus is on Europe. Folks, you can all make the case that the U.S. is not fixed. It just so happens more of the market attention is on Europe. But if you're thinking the U.S. ought to get its turn, well, wait a few weeks, probably more like a few months before the U.S. falls back in the spotlight. I think it's only a matter of time. And by the way, if things do get worse in Europe, there are likely to be ripple effects here in the U.S. too. And folks, I've already run past my time. Again, thank you very much for joining us. Thanks especially to Epic Street for making this event possible. We really appreciate what they do, and I really appreciate each one of you attending this event and offering your questions and your comments. And hopefully I shouldn't say hopefully, I'm believing we're scheduled to do this again tomorrow. I'll be here, same time, same place tomorrow, a little less than 23 hours from now. So I'll give you a 23-hour break from listening to me blab about all things Forex. Folks, have a great day. Cheers.